Hello, everybody. Sorry for the late start. They used the wrong Zoom account and we couldn't figure out how to log in to this particular Zoom account. So I appreciate your patience today. I'm Sharon Lewis, and we have a lot to cover in discussing the One Big Beautiful Bill for Business. So let me bring it up on the screen here for us to get started. Did that. I love it when a plan falls apart on you. Admit all. So I'm Sharon Lewis, and I'm for those of you who aren't regular clients or know us, I'm a tax professional. I've been doing taxes for, this is my 23rd year. I have a background in business, and my goal is to help businesses make the most of tax law changes and to get the most out of it so that they can pay the least amount of taxes. My philosophy is everybody has to pay their fair share, but we should all be able to pay the least amount possible. So let me bring up. Okay, no one else is in the waiting room. We can share the screen. All right, so hopefully you all can see that. If you want to let me know where you're at, especially if you're new to us, if you let me know, where you're located, that would be great. So one of the things that happens is every president uses the tax law to steer the economy in the way they want it to go, where they think it's struggling along. Sometimes we have little tax tweaks, and other times we have really big tax tweaks that come up. Under President Biden, he only did a few small tax tweaks, which were geared towards the vehicles and some other things. But President Trump has decided to make a huge tax change. And some of it is just to steer the economy to try and stimulate it to keep it growing, and stabilize different sectors that may be slowing down. This isn't about politics. This is where the opportunities for you as a business owner can apply to make it so that you're paying less in taxes, and some different strategies that you can take. All right. So let's talk first about cash flow and depreciation and expensing. So under the previous law, 100% or bonus depreciation was dropped down. Now, there are different types of depreciation, and that's where having a relationship with a tax professional helps you out. Is sometimes bonus depreciation when you're purchasing an asset is the best, tool, but bonus depreciation was going away. We didn't have it in 2020 for 2024 tax year at all, and it had been phased out. Trump turned around and said, nope, we want to stimulate the businesses and the economy. We want to give businesses more ability to invest money into purchasing equipment, tools, furniture, whatever it is, buildings, whatever. And so they're offering the increased in bonus depreciation for that. Now, the other change is Section 179 depreciation went into effect. And normally depreciation is the IRS figures out the life of an asset. So if we have a computer, it's a 5-year asset. If we have tools, they're 7-year assets. If you're buying equipment or machinery, they're 7-year assets. Those assets, some of them can be depreciated on a very quick basis. Section 179 is taking 100% of that depreciation during the first year. Where bonus depreciation is electing to do that, but they have advantages or disadvantages to them. Bonus depreciation looks just like Section 179 depreciation for those that don't know. But what it actually does is it gives, if you're going to sell your business, or you're going to sell an asset maybe after a couple of years use, it's just to get you through whatever hurdles going on, bonus depreciation may be the better way to go because you don't have to recapture it. So that it's a tax planning tool. And everything that I'm going over today is actually tax planning and strategies to help minimize. None of it is, I'm going to do this today and it's an instant fix. It's how do I look, and it will affect, like some of these go into effect in 24, for 25, and some of them go into effect into 26. And so we'll cover that so that you know where these apply. So let me give you a case study. There's a construction company that wants to purchase $120,000 worth of equipment. By taking bonus depreciation, he can take that whole amount this particular year. Let's just say that they want to sell their business in 4 years. That equipment is a 7-year piece of equipment. If we took Section 179 depreciation and they sold their business and that piece of equipment with the business, they would have to recapture it, which means the depreciation that we took under the Section 179, you would actually add that back as income. Well, that doesn't do anybody any favors. So discussing also with your tax professional what needs to happen so that you're planning for the future. So if you know that you're going to be exiting in a certain number of years, we want to do different types of depreciation. Now, not everything qualifies for Section 179 depreciation. Vehicles, only a certain amount qualify for that. And that's my next case study. So a few years ago, we actually did have bonus depreciation in place. One of my clients is a plumber. They buy box trucks for their plumbers that work for them. He decided to buy 2 box trucks in November to help minimize his taxes. He didn't tell me he was intending to sell his business in 2 years, that he was actually in negotiation with another company to buy his plumbing company. They were a $4 million company. So we did bonus depreciation in this 1 year. Then we did it again in the next year. And then I found out that he signed a contract to sell the business. Well, we did the Section 179, not the bonus. Had he told me, we would have selected the 179. Or we wouldn't have selected the 179. We would have selected the bonus. So he caused himself to have more taxes by not explaining to me that he really was trying to exit the business. So it's important to have those conversations. But how this accelerated depreciation works is that it's going to reduce your taxable income by that entire amount. So if you spent that $120,000 for that new construction equipment, or the $60,000 for the 2 new box trucks, that reduces your taxable income by that amount. So it's a great strategy in planning for taxes. This one's one of my favorite. This is called qualified business deduction, okay? And it goes through for your pass-through entities. So if you were an S corporation or a partnership or even a sole proprietor, QBI was set to sunset. Now, QBI is like an automatic coupon for your profits for your business. Because your business made a profit, the government's going to give you an extra reduction in your taxes based on 20% of the business's income. And there's some thresholds to it, and there's some industries that don't qualify. So like real estate agents or attorneys or other types of businesses that make over $300,000 a year, you're going to fall out of qualifying for QBI. But for many business owners where their profit is under that $300,000 range, this is a great opportunity. And it works for even businesses like a sole proprietorship or a disregarded entity that still files a Schedule C. They still get that up to 20% deduction. So planning matters in this instance because distributions affect your QBI. And so if you're taking more compensation out in distributions and less out in salary, you get less QBI. So you have to look at and plan a strategy around that to be able to do that. But it's one of these things where it's like the government is willing to give you a discount on your taxes, but you have to follow these rules to do it. And again, this is a tax planning thing, but for people who just are normally running their businesses, take their regular salary, it is a reasonable compensation for the industry, they're going to get a QBI deduction off their taxes, which again reduces their taxable incomes, therefore paying less in taxes. So why this is important is this is keeping people focused on A, creating a profit, but B, people who are interested in starting a business actually can, can put, plan to make a profit, and businesses that are already making a profit, it's helping them, reduce the tax burden so that they have more money to invest in the economy or even their retirement at this point. All right. This one here, interest deduction changes. This is for businesses that have had they borrow money for expansion or different things like that. What happens is at a certain point, you can't deduct your interest expense. And so the IRS just says, nope, you're borrowing too heavy, you can't deduct this. And it was what normally adjusted it downwards to minimizing how much interest was deductible on the business return was how much depreciation and amortization you have. These two things are no longer counted against it. So they changed the rules on how to apply this deduction. The old rule, minimized how much you could deduct. The new rule allows for it. So line of credits versus venture capital might actually be a better option for certain businesses. A VC, they're going to want a percentage ownership, and that may have been the only way to grow. Well, now having a bank be the partner might be a better aspect because they're really not a partner, and you're going to get the interest deduction. Think about this. I have a case study right here. It talks a little bit about, if, like, say another construction company, $2 million in profit, $2.5 million in profit, they want to expand from residential because we're building out or further out. They want to expand from residential to commercial, maybe commercial remodeling. So, but they need additional equipment for that, and they want to hire some additional workers to be able to do that. So they go to the bank and get that line of credit. Now the interest on that line of credit is fully deductible, where before it would have been at a limit. So the result is like a tax savings of up to 25% for a business that's willing to do the expansion and borrow that money so that they can continue to use it. It could also be used, this was just an example, but it can also be used for funding R&D, for, buying new equipment. There's just a bunch of different things that it could be used for that businesses are not going to be hitting that threshold or that ceiling anymore and not being able to deduct that interest. So that one's really a great attraction for, helping business expand. A lot of my clients this slide doesn't apply to, but I thought it was important to mention because some businesses may want to look at this. Employer child care credit has been expanded, especially for small businesses. So if an employer actually helps pay for child care, maybe they've got some stellar workers, maybe they're hiring consultants with, a very specific skill set, and they want to keep or attract those employees, they might offer to pay for child care. Well, the amount that they can deduct to pay for child care has gone from 25% up to 50%. So that might be a great thing for certain businesses or industries. The other thing is that family paid medical leave credit has been made permanent. If you have an employee that's sick, or has a family member that's sick, small businesses did not offer or have to offer family medical leave because it was a deterrent to us. We had a lot of hoops to jump through to be able to apply for it. The employee had to do certain things and the employer had to do certain things. And the way it worked was that employers turned around and said, this is too much red tape to do this. We'll just pay you your salary, we'll just do this, and then they're not going to get the benefit for it. They're not going to get any tax credit, or they just say, we don't offer it. Well, now you can actually offer it, and it's at a tax advantage for your business to be able to do that. Thus, helping businesses that have a lot of turnover maybe be able to keep key employees that are important. For restaurants, you're going to be able to have more meal deductions. So before you were only able to deduct a small portion of what employees ate. Now you're able to deduct 100% of that from your gross revenue. And so that will help. that will also help with uh, trying to keep those employees, because it's so easy for, staff in restaurants to change from one restaurant to another. They don't like something. Well, if you're offering this as a business because it's advantageous to you tax-wise, it might be beneficial to offer it so that other businesses that are not offering it because they're not paying attention to the tax law, and thus keeping more people, slowing down your turnover. So one thing to keep in mind is the culture that's provided, and these things increase the cash flow, and then you have these credits for it. This creates a workforce stability, which is one of the things that they've been seeing over the last 8 years, 10 years. We've had a lot of instability. We've had the quiet quitting. We've had these different things go on. And the idea is to try and stabilize the economy. Because what happens is every time a business has to hire and train a new employee, they're losing basically 3 months or longer, depending on what the profession is, of actually how much money that person makes. So the studies of this have shown that if we can help employers keep employees, that'll help with turnover. A lot of businesses I know don't want to hire, because why bother to hire someone? They're only going to last for 6 months. It costs me more. I'll just stay at this level instead of expanding. Well, now the government is trying to say, we want you to expand, we want you to hire more people, because that will keep people off of unemployment, and more money in the economy stimulates, you know, stimulates continued growth. So I thought this was an interesting slide, although only a few of my clients will it even apply to. This one here, so this is real estate and housing impact. So we've seen, especially with the raise of the interest rates, we've seen how residential housing has really struggled. This one allows for development of low-income housing in markets, and that there's tax credits for building that. In fact, in Arizona, well, it's all over the country, but there's these opportunity zones. If you actually purchase property in an opportunity zone that qualifies for the low-income housing tax credit, you could actually get money to help build that. And then you can also get no capital gains upon selling after 5 years. Now you have to keep it for 5 years. It has to be considered low-income housing. But think about this. If you buy a piece of property and have, let's say you spend, $500,000 or $1 million building out a 4 or an 8-plex in maybe a certain area of town, Glendale, Mesa, I'm not sure where they are. I looked up the opportunity zones a couple of years ago, and you don't have to do it in an opportunity zone. But what I like about the opportunity zones is that there's no tax on the gain. So if you spend $1 million and you sell it for $1.5 million, you just got $500,000. That is zero tax. So that's the benefit of the opportunity zone. But even if you just build it in someplace else, if a builder builds on that, you're the owner of it, you get tax credits for it. The idea is to get more money or more people into housing, because when COVID happened, a lot of low-income housing projects push those people out because they could get more money for other people who don't qualify for the low-income housing vouchers. So this is relevant for, developers, construction firms, local economies, real estate agents that specialize in this type of things or want to swing into that type of thing. It's a way to get money and see bigger projects, but it's also a way to help the community. So we're going to start seeing probably some more large firms, larger construction companies, larger retirement organizations creating some of these housing projects. But it's not limited to just those companies. If you can get the capital behind it and build it, find the piece of land, this could be a viable business opportunity for people. And then the benefit of, like, if you're running a Section 8 project, those people are not allowed to damage your property, because if they do, they lose their voucher. So even though everybody says, oh, I don't want to rent to those kind of people, they will lose their voucher if they damage your property. So they need to come and go and leave it, in reasonable use condition, and not, trash the place. So it has some great benefits to it. Energy sector shifts. This is a big deal for people who are in this. there is now foreign entity restrictions on solar projects. So one of my clients was getting ready to do a solar farm, and I guess the investors, because some of the Trump credits rolled that back completely. So their solar farm, even though they've been in the development stage, has actually stalled. We're actually seeing the rollback of some of the clean energy credits. What that means is the ROI is less certain. So if you're thinking about doing that, maybe putting solar panels on your building, that might be something for you to actually sit and run the numbers for, because the ROI might not be there for it, especially without the tax credit incentives and the extreme cost of solar, because those panels are being sold at what I consider an overinflated price. But we're seeing this come across the board right now. So that's kind of like a, hey, don't do this, you know, notice. All right. I don't know why this slide is in here twice, but the slide is in here twice. I will have to fix that. One of the things that I didn't cover under the restaurant thing is, if you are a restaurant owner or in any industry where your employees customarily get tips, people are spreading a rumor that they do not have to count the tips at all anymore. That is not the case. Tips are still taxable if they're over $25,000. So if somebody's working at a high-end restaurant, that could be, their tips for half the year, depending on what the dollar amount is of the meals and stuff like that. So you still have to keep track of tips. It's going to be reported separately on the W-2 form. So there'll be two different boxes for tips now instead of just the one box that's there to keep track of it. You will still have to pay FICA and Medicare on it. It means there's no income tax on it. You still have to pay the Social Security and Medicare, because everybody's going to want that when they're 65. If you don't pay into it, you're not going to have access to it. And considering most of these workers are not saving for retirement, if they're long-term, restaurant employees, they'll want to be paying into that so that they're getting more money into retirement. The other thing, so that keeping that in mind, that's really important for the hospitality. I thought I had fixed this when I was doing that. Evidently, I didn't save that particular version. All right. So with this, it's important for us to look at what credits are permanent and what credits are phasing out. And so it's important to sit down and talk to somebody if you're planning on utilizing some of these credits, or even some of the old credits that were under, the Biden administration or prior to that, because some of them are phasing out, and every president has the option of going to Congress and asking for them to be extended. And some of these have not been extended. And so keep that in mind. So you want to know, we want to know where you're going to be in regards to that. The other thing is that if we have a federal deficit, we could end up with a future tax hike. And that might be, if this backfires on Trump, we could end up with tax rates being increased in the next it won't happen in 25 and it won't happen in 26. It would probably happen in 26 to affect 27 if my crystal ball is any good. That's what I see, because we've got to let everything that goes into effect takes 1 year for us to actually see the monetary effect. What normally happens with people's thoughts on these is that we get positive thinking from it and then we spend money. But for the full measurement to go into effect, it takes a full year for it to come into tax, because we have to file the taxes based on these changes. So keeping that in mind, what's really important for you to benefit from these changes is actually having a relationship with your tax professional, to actually have an advisory meeting to sit down and say, where do my numbers fall? What can I do to increase my QBI? I want to purchase this piece of equipment. Do I buy this? Do I buy that? Do I buy a renewable energy vehicle? Do I not? And look at those different things to see where you're going to get the biggest tax, bang for the buck. The idea is about reducing the amount of taxes and seeing how you can use the deck of cards that we've just been shuffled to our favor. I'm all for planning and seeing how to utilize these for our favor. What's interesting about this particular tax change is this is the third of one large. So I've been, as I said earlier, I've been doing this for 22 years. This is the third major tax law change in my 22 years. And so the good news is that it has a lot of benefits. The bad news is there are some things going away, like the solar. And solar is a big industry in Arizona. So if you're in Arizona and you're seeing that, solar is going to be dropping off because residential is not going to be getting it, the only one that's still giving you a tax credit is the state of Arizona. Well, is that enough to insure the cost? And then the other thing is you'll get more money back in your taxes if you're using US solar panels. Well, there aren't any right now. They've all been being made over in China probably for the last 25 years. And so those things need to be made here in the United States. That's also how the tariffs are affecting us, is that too many businesses have been, we were using inexpensive overseas products when they could be made here in the United States for almost the same price. But these other industries are cutting our prices on purpose. And so President Trump has put that into place. We're going to see that with the chips under the Biden administration. They gave carte blanche to the manufacturing of microchips. And we've seen a lot of the chip manufacturers actually laying people off. This hopefully will stabilize that sector of the economy. And that's what I want to go into next is R&D, which is like the chip manufacturing and stuff like that. There will be tax credits for anybody who participates in R&D. And it's not just for science or anything like that, which is what I always thought. I was pretty naive about this, but it's any business improving a product, process, or even a software. So, and it applies even if the project fails. It covers wages, supplies, contractors, all of that kind of stuff. An example, you might be testing another construction method. I was sitting here as I was writing out these slides. It's like, what if we took a product that's difficult to recycle, like road tires, and we learned how to make them into something like a Lego brick, and then we use them for housing. They've got insulating features. It's like, I'm wondering if that would be a viable business model. Now I'm just making stuff up as I was sitting here, Monday night writing this presentation, tweaking it out. But it's like, what if that's something that can be done? So a construction method. A dentist developing a new workflow, or maybe, mixing some different compounds to create a better crown, or, however they do some of the stuff in their office, developing that out. A software, even an application for a telephone, that is actually an R&D opportunity. What that means is if you're spending that money, normally we would have to amortize that out over a specific period of time. And it could be up 5 to 10 years, depending on what it was. Now they're saying you're going to get 100% of that on the year you pay for it. So if you're developing one of these things, maybe you want an app that shows, houses, or maybe you want an app that shows where, for me, it would be where people's tax return is in the cycle, or, how to plug in some numbers so that you can get your own tax estimate, something simple like that. I could actually write that off this year against my income at 100% and not have to take it over that 5 or 10 year period. So give you an example, a dental practice that actually, I was talking to my dentist, he's actually working on developing a new tray system because everybody complains about the tray system they have. So he's got his budget plan. We're figuring out that he's going to have about $40,000 in tax credits. So that's something that we can, again, use, where a lot of businesses won't take the time to do this, because why do I want to spend all this money today? I have to pay that employee today. And yet, because I don't have a viable credit, I'm not going to get it, or a viable product, I'm not going to get it, or because it's part of an R&D. So that is a real advantage. I was talking to a client that works in the healthcare industry, and they do both mental health and personal well-being care. But the software they use is called an EHR system, electronics health records. Their EHR system caters to either mental health or it caters to physical health. They don't have joint ones that work very well together. And so they're having lots of billing issues. And so we were talking a couple months ago about the possibility of her finding investors to build out that product. Well, when we talked about this in June, it wasn't a great benefit. Now that we're talking about it into the future, this is a good opportunity for her if she can find those investors to do this. And it's, and she already has clients built in, which is super exciting. So there's a lot of hidden R&D activity out there that could be utilized where people get tax credits instead of actually having to amortize things out or not get the benefit today of it. So this one to me is a big deal because it causes us as business owners to think out of the box and say, what can I do to improve my industry? What can I do to improve my business model? And so that's what it's important to me is like, how can I do this and how can we bring more information out to people where they're willing to create those apps? My son gets his hair cut at Great Clips. They've got a little app where you can check in. Well, my doctor's office has the app where he can check in, or where you have to check in and fill out the paperwork. What if there was one for your industry, that helped people that wasn't related to any of those big names that are, competing against you? All right. So this is my contact information. I hope I didn't cover this too quickly for you. I wanted to be cognizant of everybody's time and people, if we're business owners, business is money for us. So I wanted to make sure that you got everything. My name is Sharon Lewis. If you want to book an appointment, you can reach out to admin@lbstax.com and he will get you on my schedule. These are our telephone numbers. And then our next webinar is actually set for October 16th, and it is tax savings to business growth, building a smarter financial strategy. So we're actually working on strategies for business owners, going through and helping them see where they could be losing money to improve their cash flow and being able to start setting aside money for retirements if they haven't been doing that. Because that's one of the things that I discovered from a recent class I took is many business owners were not putting enough money into retirement, and we're thinking when we sell our business we'll be able to get all this money, and it doesn't always work that way based on statistics. It might work that way for you, but based on statistics. So now we're going to look at the finances behind that to see if we can get businesses to grow, for owners to be able to put money aside. So anybody have any questions about today's webinar? All right. Well, I guess we don't have any questions. I appreciate your attendance. We will have a recording of this going out to people. It'll be a slightly different version of this webinar, but it will come out. It'll be the same slides with a correction because I have to do it again for something else. So I appreciate you being here. Thank you very much and have a fantastic day.